Hello folks, welcome to another tutorial video on intraday trading. Today we're going to be talking about one specific tool that is actually rather important for intraday trading, and not many people actually talk about that or teach about the what I call the round numbers. Okay, in my opinion, round numbers work as some sort of the pivot points, the magnet points of intraday trading. Okay, they are key points where price tends to gravitate to or away from an intraday point of view. All right, now what are the round numbers? Well, on a four-digit currency pair such as the euro against the American dollar, or also the sterling pound against the American dollar, any four decimal currency pair, well, round numbers are segments every 50 pips. For example, 145.00, 145.50, 146.00, 146.50, etc., etc. Now, on two decimal currency pairs, such as the American dollar against the sterling pound, well, that would be 91.00, 91.50, 92.00, 92.50, etc. All right, every 50 pip segment is a round number. Now, why are they important? Why am I even mentioning the round numbers to you guys? Well, again, since they work as intraday levels of support and resistance, as intraday pivot points, they allow us, they work, or they let us map the intraday price action. All right, they well, it's some sort of a work frame upon which we can base or we can structure our intraday trading strategies. If let's assume we are trading the euro against the American dollar, all right, and therefore our round numbers 145.00, 145.50, 146.00, 146.50, etc., etc. Well, if if we get a market reaction of the 145.50, let's assume a bounce reaction, chances are price will tend to gravitate away from this number towards the next one immediately above. In this case, 146.00. In the other hand, if we get a breakout price reaction of that 145.50, chances are price will gravitate away towards the next round number immediately below, in this case 145.00. Now this is very useful because it allows us to use it, as I was saying before, as a work frame in order to base our entries between those round numbers. Okay, what we want to do, if we get a bounce, for example, we want to search for our entry as close as possible from that round number we are getting the bounce from, all right, and our exit level, our first target, just immediately before hitting the next one. The ideal location, okay, the ideal intraday trade would be to, well, locate our entry and our exit between two immediate or two following round numbers. Again, also, if we get the breakout, obviously we would be searching for our entry as tightly as possible from the 145.50, obviously from below, for example, 145.45, aiming to profit from this down move to the next round number immediately below, just a little bit before, all right, before the next round number, let's say 145.05. Those 40 pips between 145.45 and 145.05 is where we want to squeeze our profits, at least our first target. Then we may choose to let a second portion of the trade run to further profits down below, for example, to the 144.50. All right, since it's the round number immediately below the 145.00. But at least the first target, okay, the first portion of the trade, we want to squeeze it between these two round numbers. Obviously, if your entry comes somewhere in between these two round numbers, let's assume we get a bounce of the 145.50, and your actual entry as per the systems we are going to be reviewing in just the following video. Please guys, remember we are still reviewing the theory here. We are going to have plenty of time to actually apply all this into our actual forex chart. Just bear with me one moment. Well, if as per the systems and the techniques I'm going to show you in a future video, we get our entry somewhere in between, let's assume 145.70, 145.80, 75, somewhere in there. This is not an ideal location to click, an ideal placement, location, whatever, to click our buy button, because we just wouldn't have enough room to profit until the next run number farther up. Okay, again, the ideal location is to squeeze your entry and your exits as tightly as possible in between two immediate round numbers. All right, this is exactly the type of move you want to profit from as an intraday trader. All right. Now, the question is, why do these round numbers work? Okay, why do we get market reactions? We usually get market reactions from an intraday point of view of those round numbers. Why does that happen? Why, whenever price bounces off one round number, it tends to move away from that level into the next one immediately above, or if we get the breakout, it tends to fall down to the one immediately below? How is that? What market mechanism happens in there to, well, have price behave in such manner? Well, the reason for that is large investment traders. Okay, I'm talking about central bank traders, fund managers, big traders working for investment banks, etc., etc. The big guys actually moving the market. Those guys, please mind, they don't trade 5-10 lots like you and I could do. They actually trade hundreds of lots per individual position. All right, every time they click on their buy and sell button, literally millions of dollars are slapped into the market. Therefore, those are the guys that pump the market volume, all right, the trading volume into the market. So since those guys usually work on a longer term perspective, they are not really intraday traders or scalpers. Okay, they move so much money, okay, so much trading volume, they cannot react quickly enough to the intraday charts. All right. At the end of the day, please mind that there is one thing called liquidity, and if you are to buy or sell, let's say 500 lots, all right, on any particular currency pair, let's say the Australian dollar against the American dollar. Well, if you had to move to buy or sell 500 lots, you couldn't just do that from an intraday point of view, okay? Because market liquidity, is not endless, okay? If you try to buy or to sell, let's assume a 500 lots of the Australian dollar against the American dollar, for example, that means that there needs to be someone else, okay, at the other end of the spectrum, willing to buy those 500 lots from you, all right? And, well, again, market liquidity is not endless. All right. So from an intraday point of view, those guys moving so much money, they cannot react so quickly they just can't trade the intraday charts like you and I do. Because whenever we take a trade, hey, what do we take trades with? 5, 6 lots, 10 lots, 3 lots. Some of you may be even trading mini lots. All right, so those small orders are very quick to to trade in and out of the market, because we just don't have our requirements as far as finding a counterpart to buy or sell those 5, 10, 3 lots from us. It is not really difficult to find a counterpart in the market. Okay, whenever our broker executes our order to buy or sell 3 lots of the Australian dollar against the American dollar, well, they usually find a counterpart instantly. However, if we were to punch a trade with 500 lots, trust me, it will be a whole different story. All right. So these guys, they don't trade the intraday trading. I mean, the big guys, okay, the big dogs, trading the market for trading the forex markets for, again, institutional investment funds, institutional banks, etc., etc. So what they do is they trade off the daily, they trade off the weekly time frames, all right? And obviously what they do is they simply base their entries, their exits, their profit targets around the round numbers. Okay, they just wrap it up. So instead of just searching to locate their exit or entry orders at 145.15, they just simply, if they entered, for example, at 150 double, which would be somewhere up there, all right, they aim for 500 pips and they simply locate their exits at 145 double. All right, it's a psychological thing. All right, they simply locate their pending orders, again, their buy or sell order, their stop loss order, their target price order around round numbers. So as a result, what we usually have from an intraday point of view is a number of massive orders sitting around these round numbers from those large institutional traders, and therefore whenever price touches one of those round numbers, a bunch of large orders are executed right away. Again, it can be either an entry order, a stop loss order, or a profit taking level. At any rate, price is bound to react off those levels because, again, once price touches those levels, thousands of lots around the world from those big institutional traders thousands of orders are triggered immediately, and price therefore is bound to react, okay, off those levels. Again, either a breakout or a bounce. Please mind that price moves whenever there is a volume behind moving price in any given direction. If there is no volume, if no one is either clicking on the buy or the sell button, price is not moving anywhere. All right. In order to have momentum, in order to have volatility, there needs to be trading volume moving price, okay, pushing price forward. Well, and what moves price? Again, volume. All right, orders, actual orders, and that's why price does react off those round numbers, because that's where those large institutional traders base their order tickets around those levels. Okay, so honestly speaking, the only thing we are doing here as a small intraday retail traders, people trading small lots, is, well, basically we are piggybacking on what those big guys are actually doing. All right, if those guys are creating a bounce reaction of one round number, we are trying to piggyback with our 3, 5, 6 lots, however many lots you are trading as an individual trader, and just trying to piggyback on that quick market reaction. That's our job as intraday traders. Okay, please mind that small traders such as you and I, we don't move the market. Only the big guys, the big trading desks in, again, investment banks, etc., etc., those are the guys who move the market. Our job as intraday traders is to simply piggyback on the market reaction, okay, on the acceleration they create, and we just try to ride along those moves that they create up on that market reaction they create up on the charts. Okay. All right, I showed you this chart on a previous video. This is the sterling pound against the American dollar in the 1 hour time frame. Remember when I was mentioning that it's impossible to make money consistently if you are trading within ranges, okay, once price is actually flapping up and down within a range, because if you were to take any entry around that area or within that area, you would be basically anticipating the market move. And we individual traders, again, that's what I want to get down to. We do not move the market, and therefore we need to wait for the market to actually move before we can piggyback on that market reaction. That's why I was saying before that in order to trade profitably, you need to wait for any type of market bias. Okay, any type of market bias. The big traders have begun already to move the market in one given direction, and our job is to simply piggyback on that market reaction, on that market impact that those large traders are actually creating or actually basically driving price in one given direction. Our job is to piggyback on that move. Whenever they have not begun moving the price yet, whenever they still have not positioned themselves strongly enough to move the market in any given direction, such as in here, your job, your responsibility is to wait, to stay out of the market, since you cannot move the market, you cannot do nothing by yourself. You need to wait for these guys to begin moving the market in order to, in order to try to, again, jump on board, ride on their back, trying to, fish as many pips as possible from the move they have created, not from the move that you create, because you cannot create the move. Okay, you don't have the trading volume enough. We individual traders don't have the trading volume enough to move the market. We need to wait for them to move the market, and then we simply jump on board as quickly as possible. All right, well, basically this is exactly the same principle. We wait for price to touch one particular round number. We wait for the market reaction, either the breakout or the bounce or the breakout, and then we simply piggyback on that move, either shooting for the next round number above that reaction level, or for the one immediately below. All right, that's gonna be the principle here. Again, as far as taking the actual entry and the actual exit, don't you worry. We're gonna be covering that in detail in future videos. But I wanted you guys to understand the concepts, okay, the theory behind what we are doing here with round numbers. All right. And now finally, just to prove my point, just to drive the point home, let me show you an actual Forex chart, okay, just to make sure that you understand how the round numbers do look like on an actual chart. Give me a second. Alright, I've just pulled a random intraday chart. This time around is the New Zealand dollar against the American dollar, 15 minutes time frame, again typical intraday chart. Well, let's look what the round numbers look like on our chart, or actually more importantly, let's take a look at how how price is reacting to the round numbers, and to verify whether we can map the intraday price action from the round numbers perspective. As you can see, this is live current market price. Actually, as I record this video, today is Sunday, so this is this is Friday's closing the price, and let's take a look. This is what happened last Friday. All right, this is the end of Friday's session. This is the beginning of Friday's session. This is Thursday. Okay, price action, etc., etc. Well, on Thursday, price came up to touch that level 0.72, the below round number. He couldn't break through. He came back down on Friday morning, early in the morning, to retest the 0.7150. It couldn't break through, could it? So it reacted off this level, came back up, then it came back to retest this level once again. Again, 0.7150. Once again, it couldn't break through. We got another reaction in this time around, a bounce reaction, just as we got here. Well, where did it go? To the next round number, 0.72 below. This time around, did we get the bounce reaction? No. What did we get? We got the breakout reaction. So we got the breakout, pullback to retest that 0.72 below level again. What type of reaction did we get? A bounce. All right, bounce. So again, please take a look how we can indeed map price action from an intraday point of view, just by analyzing price reaction of those round numbers. Again, bounce, comes back down to the next one, bounce, pullback, bounce, breakout, pullback, bounce. All right, see how we can indeed exploit those round numbers, at least to again implement some a work frame on our intraday charts to better analyze the direction or the price reaction of those levels. Okay, and therefore, for example here, if we got a bounce, we could have squeezed our entry as tight as possible from there, aiming for the next level. All right, next time price comes to retest this level, do we get the breakout? No, we don't. Do we get the bounce? Yes, we do. Course of action, same as in here, or same as in here, or same as in here, a bounce. Do we get a breakout? No, we don't. We get a bounce. Course of action, entry as tight as possible from that round number, immediately below that round number, aiming for the next one immediately below, 0.7150. So obviously, you cannot trade exclusively off round numbers. Again, in future videos, we are going to be looking into actual, entries and exits, parameters, strategies. But I wanted to show you guys this video on how we are going to implement, again, on a future video, round numbers into the whole equation. Because indeed, they can be very, very, very beneficial to our intraday trading, all right? At least, again, to a structure to map the intraday price action. Alright guys, that's about it for round numbers and their importance on as far as intraday trading goes. Please keep in mind that once we actually reveal all the elements of our intraday strategies on a future video, we are going to indeed implement the round numbers on the equation, and more specifically, as mentioned before, we are going to be searching for our entries and exits between two following round numbers. Again, if our entry comes somewhere in between, all right, that's not going to be an optimal entry level, because we are going to have resistance just above our entry price, or if we are to sell or finding a sell opportunity, we are going to have support immediately below that level, and we don't want that because we may get a bounce, all right, and that's obviously counterproductive for our interest. The best optimal entry from an intraday point of view is to squeeze this portion of the chart, all right, and to make your pips, your profits in between two following round numbers. All right, I'll be seeing you on the next video.